Today in the show we have news from Franklin Payroll. We have State Street dabbling into tokenized deposit, the updates for crypto from the Basel Committee, and so much more. I'm your host, Mauricio Magaldi, and this is BlockDrops, your weekly digest on blockchain for business. These news are not a form of endorsement, sponsorship, or encouragement for consumption and are meant for educational purposes only. In the first drop today, we're going to talk a little bit about utility in crypto. And the example case here is Franklin Payroll. I mean, now they're called Franklin, but they started as Franklin Payroll. And it's interesting that they started by tackling a very prominent challenge in the world of DAOs, which is how do you pay your contributors? You don't know them. They are a wallet address somewhere or they're a PFP somewhere else. So Franklin Payroll came into the fold a couple of years ago trying to structure that. And then obviously it expanded so much more widely to actual crypto projects that need to pay their staff using the very currency that they are collecting their revenues on. And the reason why we're bringing Franklin Payroll this week is that they introduced quite a few new features over the course of last 6 to 12 months, but the two more recent ones are very interesting. They introduced accounts payable and accounts receivable to their wider platform. So if you're a crypto business, or even if you're a regular business that is starting to play with stable coins as means of payment, you can now have accounts payable, which is the pay bills functionality, and the accounts receivable to generate invoices to your customers so they can pay you even if they are dabbling with crypto. And it's very interesting that they are doing this because it is these are basic functions, business functions, that if you're a crypto-based business, it doesn't mean that you won't have to pay for your staff's salaries or pay bills for your suppliers or generate invoices for the people you supply to. And interestingly, this also behaves very similarly to other financial platforms that I've seen in traditional finance. So there's a lot of familiarity, even if the underlying infrastructure is all using wallets and stable coins. You can actually manage the business based on the metadata about everything you're doing. So in an invoice, you have the nature of the business, who you're charging, what is the terms for those invoices, what are the dates that need to happen, so when you issue that, when it's due, and all of that stuff. You also have for your own customers, if you're invoicing your customers, obviously you can generate that to your customers. And for the payroll, you have the balances and how much is owed and when to each one of your contributors. So it's a very wide and feels very much like a traditional finance, traditional fintech kind of finance management platform, but it runs on crypto. And I think that familiarity, and we talked about this many times in the show, familiarity breeds adoption. And I think that obviously it's not only Franklin doing this, but the way that they are evolving into becoming increasingly more of a crypto fintech kind of points to a trend and direction that you will see as crypto becomes increasingly more mainstream. It also becomes more integrated into how the companies, the B2B and B2B2C companies, run their business with a lot more tooling and a lot more ease of use because they're running on crypto rails. In the second drop today, we're going to comment a little bit on a new report about State Street that they are exploring participation in a variety of digital currencies and stablecoin initiatives. State Street is no stranger to crypto as a asset class. They are an investor in Finality, which does interbank payments using Quorum as the protocol. And they're also exploring tokenized deposits and stablecoin in the context of tokenization. It's interesting that State Street, which is one of the oldest banks and one of the most traditional financial services firms in Wall Street, is starting to peek into more of these spaces because tokenization has been the talk of the town for all of their competitors, including BNY Mellon and players like BlackRock. And it's interesting to see that being such a big participant in traditional finance, it's taking quite a while for State Street to start those initiatives. They did have a group of people dedicated to crypto assets, and that group has been assembled and disassembled a few times. But it's obviously interesting to see that this is something that is emerging in the company right now, being such a big player. I think the context in which the State Street team is starting to be pushed into that is not only client demand but also the competitors. We're seeing in the market firms like Franklin Templeton and Wisdom Tree obviously starting to dabble into tokenized bonds, tokenized other RWAs. And as we say here in the show, tokenizing an asset and bringing them on chain is just notarizing them on a decentralized data infrastructure. The real value comes with programmability. It comes with fractionalizing those assets to allow for a lower ticket and reduce the barrier to entry, which is similar to what people would call democratizing or creating financial inclusion, and also liquidity, right? So when it comes to tokenizing things into a public chain, then you have the counterpart, a possibility to have the counterpart liquidity coming in the shape of other crypto assets or stable coins or tokenized deposits. Being a regulated bank, it is very likely that State Street will start with things that are closer to home, such as tokenized deposits. But the fact that they are assessing the possibility of partnering with a stable coin issuer for some of the products is indeed very interesting. Tokenized deposits are being used in context of CBDCs, the central bank digital currencies, and it's obviously something that banks that are heavily regulated, like State Street, will definitely pay attention to. And CBDCs being a more centralized form of digital fiat, tokenized deposits, a less centralized but still very heavily regulated, and stablecoins being what we call the open sea of digital fiat. That comes in context of increasingly clarity of regulation if you pick MiCA in Europe, for instance, but there's also a lot of risk angle coming into play, and we're going to talk a little bit about that in the next drop. See you there. So in the third drop, we're going to talk a little bit about the updated recommendation for bank compliance that came out this week from the Basel Committee on Banking Supervision. For those of you unaware, Basel is not only the city, but a committee that helps banks and regulators to come into terms and define the best risk approaches to a variety of different banking products and banking management practices. And they are indeed looking into crypto as both a technology and as an asset class. This time around, though, they made it not so clear because some of the outlets and some of the analysts did miss this, but they are categorizing stablecoins and any other digital securities that are issued on permissioned blockchains more secure than the ones issued on public blockchains. I'm going to repeat that. The Basel Committee is looking to determine the degree of risk of an asset based on the type of blockchain that that asset is being issued on. So those so-called private or consortium or permissioned chains are the ones that can be categorized as a lower risk category. This is a blow to crypto assets such as stablecoins, and as we were talking about in the previous drop, this might impose or require from banks that are playing in the public blockchain arena with stablecoins to have a different mix of risk capital to manage this exposure. Every type of category that an asset is attached to requires a different degree of corresponding reserves to protect that institution from a potential mishap in handling those assets, which means that Basel itself is looking into the very technical infrastructure to determine the degree of risk each digital asset will carry when looking into the risk-weighted asset calculations. And risk-weighted asset, it's another RWA acronym that the industry already uses. There are two other adjustments that are being proposed by Basel regarding stable coins. The first is that reserves have to be remote relative to the issuer and custodian for a particular stable coin. This plays a little bit on the separation of duties, which is very common in traditional finance. And the other one is that banks that only provide custody services for a stable coin, they're not required to keep the cash balances separate from other bank deposits. So if you're not a stablecoin issuer, if you're a bank but not a stablecoin issuer, you can have accounts that are used for stablecoin reserves, which is kind of a separation in and on itself. So these are kind of related, and how the banks are going to structure their own reserves to cope with the risks that are associated with stablecoins, whether you were a depositor or a custodian or you were an issuer. You will have different demands on how to handle the corresponding balances that are quote unquote pegging those stable coins. That said, I think this is going to be very controversial, and I think the banks will have to have a lot of deep dive into the technical infrastructure in terms of assessing this and having an educated discussion with the Basel Committee. And in a week packed full of news, here is more. Wirex and Visa expanding their partnership to help users pay crypto via card. Caliza raises 45.7 million reais to push international payments in Brazil. The updated Atlantic Council Geoeconomics Center cryptocurrency regulation tracker is now available. Bitso decided for Lightspark to enable Bitcoin transactions via Lightning Network. Nuclea announced a new platform for tokenized receivables, which will launch in September. Lumx announced their Latam Acceleration Fund for startups in Latin America dabbling into Web3. Cassa Depositi and Prestiti successfully issued their first digital bond on blockchain, a first of its kind in Italy. Polygon, Accenture, and Google Cloud announced a new report aimed at Web3 loyalty use cases. Standard Chartered, Animoca Brands, and Hong Kong Telecom are jointly exploring stablecoin issuance in the regulated environment with the help of HKMA. Catch us online.
We're on Instagram at BlockDrops Podcast, on Twitter at BlockDropsPod or 0x Mauricio. We're on Lens at blockdrops.lens. We have a newsletter on LinkedIn. Write to us at blockdropspodcast@gmail.com, and you can listen to the BlockDrops podcast at Spotify, iColab, Faberbun Tech, and all of the other major streaming platforms. Yay!
Shoutouts today to the people who share the links you will find in the episode notes: Kai Sheffield, Ezra Kebrab, Dante Disparti, Thales Freitas, Leandro Pereira, Caio Barbosa, Megan Nab, Rita Martins, and Caitlin Long. Don't forget to leave the ratings on your favorite player. This is all for today. Stay rare, stay weird, LFG.